September 21st, 2023. Today we got a large gap down, and when you get a large gap, the first thing you got to look at is the prior day's low. You can see today we never ended up getting back to the prior day's low, which sometimes happens. I have some examples of large gaps down, and bear trends. I have 7 examples, and you can see starts with a big bear bar, starts with a bear bar, closing near its low, starts with a big bear bar. Today started with a big bear bar. And then we have 3 examples that did not start with big bear bars. But when you get a big gap down and you get a bear trend day, the majority of the time you're going to get a big bear bar. And between, this is in large gaps down. So everything here is a large gap down. These are all trading ranges. This is, a couple of bull trends. And I have 23 total examples. And of those 23 examples where we got a large gap down, you can see that 7 of them led to bear trend days. So there's about a 1 in 3 chance, if you trust my statistics, there's about a 1 in 3 chance that when you get a big gap down, you're going to get a bear trend day. And when that happens, when you do get a bear trend day, the vast majority of the time, you're going to be getting a bear bar closing near its low. So you can see we do get that on 1, you get a bear bar closing near its low, but the follow through on 2 has a big tail on the top. And that's a problem because when you get so much overlap, traders are less eager to sell. And it's the same problem with 3. You have big overlap with the prior bar on 2, big overlap with the prior bar on 3. The size of the bodies are shrinking, the size of the tails are increasing, which tells you that it's probably a trading range. So bar 4, disappointing for the bears. You can see anyone who was, short below 2 was disappointed that they weren't even able to really make a profit during 3. Pretty much just triggered their entry and sat there. And so a lot of them scalped out for basically break even during 4, and that's why we got that big tail. 5, we get some follow through for the bears. Probably buyers below 4 generally, so you can expect that even after 6, we're probably going to pull back to the 4 low. And that's because this is probably a trading range. We're not going to continue in this tight channel down all day. And with all these tails here, bulls are not convinced just by one big bear bar that the market is overly bearish. They're still thinking it's probably a trading range because of all these big bear bars. So bears get some follow through on 7, but bears who sold 6 wanted a big bear bar closing near its low that looked exactly like 6 to confirm the breakout, and they don't get it on 7. And so a lot of those bears just buy back shorts at the market, and that's what causes the bounce on 8. You also have bulls who know that bears need another big follow through bar on 7, so they're basically going to buy the close of 6 and hope that we don't get a big bear bar closing near its low. And they weren't disappointed. We didn't get that. And you can see bears bought back their shorts at the market. Even if you were a bull and you were disappointed in 7 and you were willing to exit below 7, you never got triggered. So you can see that bulls bought the close of 7 as well, trying not to let it trigger to let other bulls exit. And we got to rally up. 8 is an interesting bar. You could argue it's probably always in long now. So when we got the gap down and from bar 1, it's clearly always in short. And from yesterday, with how strong yesterday's channel was, it's always in short. But, when you start getting follow through around here, you can, again, like I said, confirm it's always in short, but 8 is a big bull bar closing near its high. And it's an exceptional bar. It's a lot larger than you generally get, when you're doing this. So 8 might flip the market to always in long. But what you do know is that traders who sold above 7, think about if you sold above 7, how are you feeling when you see 8? That's like the worst bar. That's not what you wanted to see at all. And so the traders who sold above 8, you can see 9 started to turn down to try to let those traders out, but it was never quite able to get there. Bulls were, interested in buying it, maybe because they didn't want it to get there. Maybe it's a 50% pullback. It was one tick away from the 50% pullback. Bulls were so eager to buy a pullback. You can see they bought during 9, almost at a 50% pullback. They would have bought more if it got to the 7 high too. And when the market pulled back, those bears noticed that the market was pulling back and they started panicking out of their shorts, thinking that they're not going to get a chance to get out of break even. So bears panicking out of shorts and bulls being eager to buy down here is what drives the market up during bar 10. However, it's probably a trading range. This was steep, and so this will probably get a second leg. The reason it'll probably get a second leg is because it's a breakout on a higher time frame, like a 15-minute chart. You can see on a 15-minute chart, you get a bear bar and a bear follow-through bar closing near its low. And when you get a couple of bear bars closing near their lows, that means that the first reversal up is probably going to fail. And so when you get tight channels, you should be thinking that the first reversal up is probably going to be minor. And that's exactly what this was. It was a 2-legged minor reversal. And bar 11 is a low 2 short. It's a tight channel up, and it was also a tight channel down, so clear trading range. I don't think I would sell below 11 just because this, 8 and 10 are very strong bars. So It's better to be cautious here, I think. But you get some follow through on 12. So good for the Bears, a pair of bear bars. And, like what I just said, when you get a pair of bear bars strong closing near their lows, the first reversal should fail. So you can expect that if we come up here, we're probably going to form some sort of double top, which we did. 13 tried to touch 7 again, but any bear who was still short, you can see they bought back their shorts basically at the same price they did on 9, one tick lower. Trying to think if there's a ton of significance to that. To me, that just signals that we're in a trading range, in this trading range. And you get a big pullback on 14, but no one really believes in the bulls here. I don't think when you get 14, because 11, 12, and 13 are a strong enough spike to, again, make the first reversal up fail. So bulls need follow through on 14, and they're probably not going to get it. Furthermore, if you bought the close of 10 and you see this and then you get 14, are you, really excited to add on to your position? If you bought over here and you come down here and then you start to get this, does this make you want to add on to your position? Or does this make you want to just start to exit your longs around break even, thinking this is probably a gift? That's what you should be thinking. 15 is a double top. When you get this double top, the neckline of the double top is 13, and bears want a break below 13 and some sort of measure move down, which they basically got on 33. So if you sell below 15, you're hoping you get a close below 13. I think a good general rule for double tops and double bottoms: identify the neckline, and you want your follow through to close, in a double top, you want it to close below. In a double bottom, you want it to close above. And the neckline is, so if you have this point and this point as your double top, the neckline is the lowest point in between those 2 points. And it's just a breakout point, basically. And so what it signifies when you break below it is the market is breaking out of something. And when it's breaking out of something, it's strong. It's, stronger than it would be without that. So bears get some follow through on 16, hoping to break below this. Side note, I think you can sell 15, but after these strong bull bars, it's hard to want to, especially without having touched the moving average yet today. But it's still okay to sell 15. You get follow through 16, 17, and 18. And basically we get back towards a new low and, traders start taking profits. I don't know if this is one tick below. Let me see. It was an exact test of the low. And why do we stop here, right? And it's kind of the same reason. We're in a trading range, and think about if you sold this close. Think about how disappointed you are if you sold the close of 7 and you see 8. Kind of the same way the traders who sold above 7 see 8, they're disappointed. If you sold the close of 7, you're mortified in 8. You don't want to be short anymore. And so 18 was those chance for those bears to get out around break even who sold the close of 7, and you can see they exit at break even, and that causes bar 19. Do you have to exit above 19 if you're a bear? Probably not, but it's a double bottom at the bottom of a trading range. This is strong enough for a second leg, but since it's a trading range, you often get really deep and disappointing pullbacks. So I would personally exit above 19, and you can just look to sell again lower. And, this is a good example of the bears not doing enough to make always in bears get short again. For example, over here, bears are short for any reason, and they'll exit above, maybe a point or two above 61 because 60 is a big climactic bar. And then you get a strong bear bar closing near its low, bears will get short again. And you get another strong bear bar closing near its low, bears get short again. Over here on 20, the bear bar doesn't close near its low. It's just basically a doji bar. And so traders are like, well, I don't know. I mean, I wanted a strong bear bar closing near its low to sell below, and I got this, so I don't think I quite want to sell below that. And then the follow through on 21 isn't able to close near its low. And, it barely closes below this. And now traders are thinking, well, this has big tails on both sides. This has big tails on both sides. I don't know how much lower we're really going to go. And so traders are starting to get concerned. Bears are starting to get concerned that, well, this channel is tight. It's probably going to lead to some sort of bottoming pattern, some sort of potential reversal. So they start taking profits below bars. And you can see that's why, there was no one interested in selling below 21. We found buyers. Sellers above 22, probably because it's a bear bar, but you got to be pretty careful taking that sell because we can bounce pretty easily here. We're just probably forming the bottom of the developing trading range, so I don't think it's smart to be selling. 24, it's a double bottom with 22, but probably not that strong. And 25 is a big bull bar closing near its high. It's a surprise bar, and it breaks out of the neckline of the double top. And if you bought above 24, what are you thinking when you see 25? You're like, wow, that's a really fast profit. I'm just going to take that and I'm going to go. And that's what happens a lot of times. So that's why you get bad follow through on 26 and 27. And you can see that if you sold above 24, you're disappointed, right? You don't want to see 25. And so the traders who sold above 24 scaled in, sold more higher. And you can see they were able to get out at break even during 27, touch the 24 high. 28, it's 2 legs up for the bulls. So, one way to look at it is 3 pushes down. We got 2 legs down, right? 1 to 3, 3 to 6, and then 2 legs up, 8 and 10. Then 3 pushes down, 1, 2, 3, 3, sorry, and then 2 legs up. So it's a wedge bottom and then 2 legs up, pull back from the wedge bottom. Sorry if that was extremely confusing. And a reasonable sell below 28, in my opinion. It's a swing short and it's a couple legs up. So it's basically you're hoping that this bear flag is going to work and lead to a measure move down somewhere down here, but it's probably not going to. And I actually had an order to sell below 29, but I pulled it when 30 was up here because if the market trades all the way up here, even if it triggers you, it's still going to have a big tail and a lot of overlap with the prior bar. You don't really want a lot of overlap when you're selling towards the bottom of the trading range. So that's why even though 30 and 31 get follow through, you can see we got basically right to the new low and then bears started taking profits. This bar was really important too. Bears were probably looking to sell the breakout, but bulls basically bought and they managed to get a bull bar. And that, if you're wanting to sell this breakout and you're hoping we collapse, 32 is not what you want to see. Why is there a bull bar there? If bears are so strong and we're going to collapse, then why are we getting a small bull bar? That's one of the reasons why when we started to collapse on 33, bears just bought back their shorts. No one was interested in selling. 34, it's a tight channel. I think we need to go a little more sideways before we got a reversal. But at this point, I think it's better to start looking for a reversal. If you took like any of these sell to close trades, you haven't really made any extra money in the past like 10 bars from like 24 to 34. You're pretty much at the same price. And so it's making me think that we're probably starting to go sideways rather than up or rather than down. However, it is still a bear channel. Come on. It's still a bear channel. It's pretty crude, but it's a bear channel and we're getting lower lows and lower highs. So it's still okay to be short. Additionally, once we saw 34, look at the breakout point on 7 to 22. You made 3.75 points, or basically 4 points if you sold below there. And then here to here, you only made about 2.5 points. So that's something to keep in mind, is that the lows are getting less and less follow through as we go, which means it's more likely that we're going to bounce. And that's a good thing to look at. It's a double bottom with 36, and we get good bar on 37, but it's the first test of the moving average, so it's probably going to fail. You can see traders will be selling the moving average with limit orders. We haven't touched it since yesterday, a lot earlier in the day. So not surprising. We just snap drawings to take. Perfect. Okay. So not surprising that we got bad follow through on 30, 38. 39 and 40. 40 is an inside bar. I think you could buy above 40, hoping for us to break strongly above the moving average. But you're kind of buying high in this trading range. And so I would be more cautious doing that. And I'd rather wait to see if we get follow through on 41. You'll have plenty of time to get in if it's going to be a bull trend. So I think I'd rather wait. 42, bad follow through, or sorry, 41, bad follow through for the bulls. And so bears will sell below this bar, and any bull who bought is disappointed at 41 and is going to exit below it. So that's one of the reasons you get follow through on 42. I think 41 is an okay swing short. Selling at the moving average is pretty much what you want to be doing on days like this where it's trickling down. And so bears can sell the moving average 41 and they get follow through on 42. But we're in an area where bulls have bought the past couple times and they end up buying again, causing 43. I did sell 42, but I sold 42 because we had been below the moving average all day. I thought it was, reasonably possible. It was a swing trade. It was a low probability trade. I thought that there was a chance that we just started to collapse down. And my plan was, if I sell below 42 and we get a bull reversal bar next, I'm going to reverse above the bar and hold long. And that's exactly what I did. I sold below 42, saw 43, just took my loss and reversed above 43. And I'm not the only trader doing that. And so, if you see something like this where you get a strong bear bar and then you get immediately a strong bull bar, you have traders who sold below 42 who are now trapped. And so traders will be buying above 43, bulls will be buying, hoping that we're going to get a swing up, and bears will be buying back shorts, covering losing positions from selling below 40, 41 and 42. And that's what causes 44, 45, 46. So this rally is partially due to bears covering shorts. This is them giving up essentially. Bears are going to give up above 43. And bulls will start buying, thinking we're going to get a bounce. Now you could look for a measure move up of this trading range. You could look for, this close, you could look maybe for this. That's a little bit of a conservative profit target though. But once you start getting these, you're in a trading range. So take maybe half off. When, I took half off when I got to the 28 close and swung the rest and exited below 50. But something to keep in mind is that, trends can go a lot further than you think. And sometimes things like this can happen where if you're short somewhere in here and you just hold until there's a reason to get out, you're holding the rest of this time and you would have made a lot of money. And so it makes sense to just hold trades until there's a reason to get out. And I think there was here. You can see there's when you get a doji bar, generally the market's going to start going sideways within 3 bars. Generally, not always, obviously. But you're generally going to get a pullback within 3 bars when you get a doji. And you can see bad follow through on 48, trader scalped. We tried to trade up again on 49, trader scalped the new high. We tried to trade up again on 50, trader scalped the new high. So basically everyone up here, traders are selling thinking that this is the top of a trading range, and we're testing the entry price of 15 bar 15. And bulls are selling, just taking profits, thinking that they're taking profits high in a trading range. And it's a tight trading range too. We got, essentially 7 dojis in a row. And so when you get 7 dojis in a row, you need to reevaluate your premise. Is it still a bull trend or is this probably just a developing trading range and I might be disappointed soon? So bulls were trying to create some sort of wedge bull flag. And when 54 was unable to close as a bull bar, you can see they just gave up and caused 55. If you see 55 as a bull, I think you need to get out below it. It's a strong bear bar and we might get a measured move down of the bull flag. So we might get somewhere down here. So traders probably are exiting. You have to exit below 55. And generally, if there's a spot where if you were a bull, you think you have to exit, that's probably a good short. So it's an okay swing short below 55. You get some follow through 56, but lots of overlap. Some follow through 57, but lots of overlap. And a smaller bar on 58, and then a doji on 59. And then you get 60, which is a big bear bar closing near its low. It's a big surprise. And it's kind of a wedge on a smaller time frame. You get 55, which is the breakout, and then you're getting pullbacks on 56, 57. So the market environment changes. I guess that's the closest way I can put it, is when, a trend changes a couple times within itself. I'm going to describe this really poorly, but I hope someone gets something out of it. When a trend changes within itself, it's kind of a wedge. So you can see a strong bar on 55 closing near its low, and then pullback 56, 57. So you get the tails. So that environment, a strong spike is different from bars with tails. These are inherently different things. And then it goes back to climactic behavior on 60. So that's 1, 2, 3. So they're kind of different things, and probably some sort of parabolic wedge on a smaller time frame. You can see it got parabolic with the trend line, right? The trend line became more parabolic. So when trend lines become parabolic, like they did here, a lot of times the market's primed for a bounce. And this is one of those times where it doesn't, but you have to keep in mind, the more parabolic the market gets, the more likely that you're going to end up getting, a climactic reversal. So 60, big follow through for the bears, closing near its low, but a lot of bears will see this as a great place to take profits, making probably a little more than they thought they would. And so bears will take profits on the close of 60, maybe above 61. Some traders take profits on the close of 61. Some traders will sell the close of 60, hoping that we get a big follow through bar that looks exactly like 60, because maybe, 30% of the time you're just going to get another big bar like 60 and you're going to get just a collapse almost immediately, or maybe even 20% of the time, but they'll be quick to get out. So when they see 61 close, they just buy back their shorts at the market. And that causes the bounce on 62. You can see 63 inside bar essentially. So what do you do if you're a bear right now? If you're a bear, in my opinion, if you're an always in bear, you're probably exiting maybe a point or two above 60 or 61, or some traders just exit on the close of 60. And you're looking to sell again below a bear bar closing near its low. 64 is a bear bar closing near its low. So it's an okay swing short below 64, probably stop above 62. And when you get 65, some traders will be ready to exit above 65, but you can see that 66 never traded above 65. So bears did a really good job of selling the close of 65, not letting it trigger, which is a sign of strength for the bears that they wouldn't let this trigger. And because a lot of bears, if they sell 64, they see 65, they're like, oh, my premise isn't valid anymore. So they'll just exit above 65. They wanted to see follow through, and it's a double bottom reversal, so they're not going to get that. But then 66 closes near its low, and they're like, well, maybe we're going to get follow through. You get bad follow through 67, but bulls can't make anything happen on 68, and bulls start to give up, which causes 69. You can see any bulls who bought anywhere in here for any reason. Maybe they bought below the low. Maybe they're trying to buy above the high and bought at the market and got trapped. You can see they were trying to form some sort of bull bar and some sort of wedge bottom, but they just failed. And then they, just gave up on 69. That's why we get the big bar closing near its low. Some followed through on 70, probably sellers above, which you get during 71, and followed through 72, 73. Bulls tried to get essentially an inside bar here or a bull bar closing near its high, and they couldn't. And even if you're an always in bear, you might be trying to exit above 75, but you can see it never triggered, showing that bears were once again really strong, and that's why we got a sell off into the close. And we have such a tight channel here that the first reversal was likely to fail. And so tomorrow, I don't know what the gap's going to look like, but if we don't really get a crazy gap, you expect the first reversal up to fail. And so, or if we get a gap up, expect another leg down. It's kind of the moral of the story here. So when you get strong channels, the first reversal is likely going to fail. Kind of like yesterday, we got that such a strong channel. The first reversal up was probably going to fail. One of the reasons we got a big gap down. I had another point I wanted to make about strong channels. I kind of forgot it at this point, but I guess you can note that 71. If you bought below 71, those traders were never let out of break even. There's gap. If you bought below this low, you maybe had one chance to get out of break even, but not really. It's hard to do. And so my overall point, I think, being if you sold any of these closes for any reason, you should be trading always in if you're not a profitable trader yet, and that is what you should be doing here: selling, maybe sell the close 64. There's not really a reason to get out. This is what I was going to say. The reason to get out of trades, if you're trading from an always in perspective, a swing perspective, is if there's a second reversal. So you can see you got 62 and 65 would have been that second reversal, or if the always in flips. So if you're short here for any reason, you get out above 8 because the always in might be long. For always in general today, I thought it was always in short on the close of 1. It was probably always in long on 8, bears exit, bulls will buy. And I didn't think it quite got back to always in short here. I thought bears needed one more bar on like 13 maybe, and they didn't get it. That's one of the reasons we ended up getting such a bounce here, is because bears needed one more bar. And generally, if you're in a trading range and you think, well, it's probably not quite always in short, but if the bears get one more bar, it's going to be always in short. They're generally not going to get it. But probably back to always in short 15 or 16, probably stays always in short. Kind of tough in here. This just becomes a mess. Probably not back to always in long on 25, still always in short. Maybe, bears probably exit above 34, I would think. But bulls probably don't buy until 43. Clearly always in long. I think it's clearly back to always in short below 55, and I don't think we ever went clearly always in long again for the rest of the day. For reasonable stop entries, I thought 15 was fine. I thought 43 was good. Thought 55 was good. 64. Those are probably the best ones that I thought I saw on the day. But you gotta pay attention to things like limit order traders getting trapped here. Like limit order traders getting trapped here and starting to panic out of shorts means this is probably going to go for at least a scalp. But yeah, that's basically it. On the daily chart, I'm using hold on. On the daily chart, we have, essentially it's a head and shoulders top. So shoulder, head, shoulder, and it divided into essentially right shoulder, head, left shoulder, left shoulder, head, right shoulder. So it's a nested head and shoulders, and the right shoulder being a little higher than the head. And you can see we're trying to break below the neckline right now. This is really strong, but it's also pretty climactic. So I wouldn't be surprised if we bounced over the next couple of days. This is just a little oversold. It's unusual for us to just sell off and continue doing it. We kind of did that over here. You can see, let me see if I can get like 3 years or something. I don't know. You can see we do this kind of stuff sometimes, but usually, like right here was a good example, but usually it's going to lead to some sort of bounce. It's just really climactic behavior. On the weekly chart, I just use SPY for the weekly chart because it shows better with the current contract. Inside, and we're getting a strong breakout on September 18th. And I think that we're probably going for this, this high right here, or potentially this high, but ultimately we probably will make one more new low. And one more thing about the 5-minute chart today. Last thing about the 5-minute chart, and then I'll finish the video. This was a nested wedge pattern. So 7, 22, 33, and then 40, 43 is essentially the higher low. But this is 3 pushes, and it's a wedge, and then there's a wedge within the wedge, 1, 2, 3 reversal. So it's a nested wedge pattern, which slightly increases the probability of 43 working. I thought 43 was probably the best trade on the day. All right, that's it.